There has been just such an amazing amount of information here and just spirit and inspiration. I mean, it is seriously good coming from you as well as everyone who's spoken here. I think Ellen and Gwen both reiterated the concept of a no-brainer. What we need to do in terms of how to increase our financial authority over money on a local level, whether that's in private-public partnership through public banks or local community associations with public banks. That's a way to basically for us to take financial autonomy back, and it is a no-brainer, and it does have a moral aspect, but it also has a financial aspect. And a lot of times I think in the sort of outside world, the concept of public just sounds like it must be just something where we're spending money and not necessarily looking at the implications of spending that money. And what has happened in actual fact is that the big six banks I talked about earlier today are the ones that are spending recklessly on things that have nothing to do with developing infrastructure or jobs or long-term growth or long-term development because they don't need to, because they have the ability to amass money at almost 0% interest. Not only that, they have the ability to amass money at 0% interest from 7 years almost of policies that have been okayed by the government, have been substantiated by the Federal Reserve, which was created, as we've heard earlier today, by the bankers for the bankers. And this is a real story. I don't get too much into history again because there's so much to cover, but it's really important to understand how even the Bank of North Dakota came about. Ellen went into some of it on her slide. But in 1919, after World War I, one of the things that happened was a banker from the Morgan Bank, it wasn't Jack Morgan himself, it was Thomas Lamont, a name no one needs to know, but he was the number 2 in the Morgan Bank, and he actually went with Woodrow Wilson over to Paris to negotiate the Treaty of Versailles. So there was such a connection between the president and bankers at the time that the major international post-war economic reconstruction treaties were negotiated with someone who was unelected and simply appointed by Woodrow Wilson. Now, this is not something that Woodrow Wilson did in isolation. Many presidents over many years had these relationships with bankers and had these positions with them and developed policies with them that were not necessarily voted policies, nor were these people necessarily voted in. Some of them did revolve into Washington, some didn't, but none of them were voted for. And this went across parties, and this went across time, this went across eras. And some of these bankers, like Thomas Lamont, had worked with Woodrow Wilson and wound up also working with FDR. So some of these people actually worked with very significant successions of presidencies over multiple decades. And that's how a lot of policies got developed. In 1919, as the Morgan Bank was at the forefront of negotiating World War I post-World War I treaties so that they could go in and be the ones to lend money to reconstruct Europe, as they had been the ones to finance a lot of the war for the United States. The Morgan Bank was involved in 75% of the private financing for World War I in collaboration with the Wilson administration. In my book, I have the letters going back and forth where it was discussed in Washington, in the halls, in the back rooms. These are the bankers we want. We know these guys. You know, they are going to be at the forefront of this. And in return for that, Jack Morgan was able to negotiate with Woodrow Wilson that any antitrust laws, any laws that would stand in the way of these big banks becoming bigger, and not being the subject of monopoly busting or anything like that, was agreed upon in return for financing. So there was things going on in the background while Congress was discussing laws that could potentially have reduced the impact and the concentration that wound up happening at these big banks, that was just continually going on behind the scenes. Now, also as a result, though, after World War I, Morgan's making all this extra money. They have all these new clients in Europe. They were the beneficiary of a policy that created a Federal Reserve that helped them to finance the war and to finance the Reconstruction. North Dakota, on the other hand, along with other farm-related states, was suffering. So this money that was coming in very plentifully to the Wall Street banks, to the New York sort of establishment community that had these relationships with Washington, was not going west. And this wasn't something new. When the Federal Reserve was passed, the act was passed, as Gwen mentioned, on the December 23rd, 1913, one of the things Woodrow Wilson said at the time was that this would be an act that would help farmers. This would be an act that would allow credit when credit wasn't available in any other way, including from the big banks, to actually filter through the country. Well, after the war, it was seen that that really didn't happen, nor was that something that the banks had designed to have happen. So when North Dakota created its bank to ostensibly help fund itself, helped fund farms that were being foreclosed upon and so forth, it was in direct retaliation and in direct need for their own financial autonomy over their state, because what was created by policy in Washington, by the Federal Reserve, by the Wilson administration, I'm picking on him because I'm talking about 1919 when North Dakota, the bank was created, but the policies weren't heading west. They weren't heading small. They were staying very concentrated between the poles of Wall Street and the poles of Washington. And that was one of the reasons that the Bank of North Dakota came into being. It was to basically control its own money, in the absence of being able to control that type of credit, that kind of money, given the current system. And so that's one of the things you look at today. Almost 100 years later, the Bank of North Dakota has a return on its equity, jumping ahead to futuristic terms, to current terms, that's almost twice as much as J.P. Morgan, which is the legacy bank of the Morgan Bank. J.P. Morgan Chase's return on equity, i.e. the return it provides to relative to the equity, the actual cash, the actual money, not all this fractional reserve stuff and all these extra leveraged things, but the money it actually returns is 10.5%. on its equity. Whereas, as we've heard earlier by a couple of different speakers, the Bank of North Dakota returns on average 22%. So on average, over the last years, and particularly during the crisis years, where JP Morgan Chase has been the beneficiary of a multi-trillion-dollar really subsidy package, talk about a public subsidy package from Washington, its return on equity has been half of the return on equity of a state that didn't have anything near any sort of attachment to that kind of subsidy. So the Federal Reserve today, in the wake of the subprime crisis 2007-2008, has effectively bought $4.5 trillion worth of debt that has gone through the banks. Part of that debt is $1.7 trillion, with a T, $1.7 trillion of mortgage-related securities, i.e. things that were connected and directly involved in the subprime crisis. And what the Fed did over the years, among their other $4.5 trillion of debt that they bought, is they bought $1.7 trillion worth of these mortgage-related securities. And they bought them at really high value. So if a mortgage-related security was worth 20 cents, they bought it at $1. So they effectively have this $1.7 trillion set of mortgage-related securities on their books. And you know who's managing? Who's actually receiving fees for whatever happens with those securities if they are bought and sold out of that $1.7 trillion pile? It's JP Morgan Chase. They're actually making money from managing the securities that the Fed bought from them and gave them money to buy. And with all of that, they still have a return on equity at less than half of the Bank of North Dakota. And the moral of that is that, or the immoral of that, is that, that when we think about public, some people think of it as this idea of subsidizing things that don't make sense in any other way. It'll be on the public to do this. It's public welfare. It's all of these terms that have this connotation like somehow that's not necessarily the most positive ideas. Well, the biggest public subsidies have gone to the private banks. And so one of the ways to turn that around, and Gwen said this at one point, we should split up the banks. We should bring back Glass-Steagall, which was an act that was passed in 1933 by FDR and by a banker, actually, who was involved. And it wasn't Carter Glass. Carter Glass is whose name is on that, but actually, there was a banker who ran Chase, at the time, which is now part of JP Morgan Chase. His name was Winthrop Aldrich. He was the nephew of a man named Nelson Aldrich, who's a very rich senator from Rhode Island, who was one of the members from Congress involved in creating the Fed to help the Morgan and other banks. But Winthrop Aldrich wound up taking over Chase right before Glass-Steagall was passed, a few years before Glass-Steagall was passed after the crash of 1929. And as a leader of that bank and as a friend of FDR, he and FDR agreed to actually help make the Glass-Steagall Act stronger, more regulatory, more strict, with the idea of dividing speculative activities that a bank could engage in relative to commercial, taking deposits and providing loans, the commercial side of the bank. He actually helped make that stronger. So just imagine a point in history. You know, it's the Great Depression, it's 1933. Chase is the second largest bank in the country. Today it's the first largest bank in the country. And the head of that bank, of Winthrop Aldrich, helps FDR make regulations stronger. Like, that is absolutely 100% inconceivable today. Right? We have Jamie Dimon, who's the head of JP Morgan Chase, the legacy of Chase as well today, who you could never conceive of doing something like Aldrich did, which was take out a front page article in the New York Times to say he was splitting his bank in two before the act was passed. So he took out this ad or this article in March 1933. The Glass-Steagall Act separating the speculative and commercial activities from bank was passed in June of 1933. So we have a history on the one side where banks can actually behave in a manner that recognizes that a public good and an economic stability and financial confidence throughout the American public is actually important. And it's even important to helping these banks become profitable. But that was in 1933. We don't have that now. And in order to develop the financial autonomy on the other side, we do need to develop it at the local level and at the state level, because we need to be able to control the funds that are our funds. There is no reason why state revenues need to go into a JP Morgan Chase deposit base and get almost no interest, which is what is happening now because of the policy that enables JP Morgan Chase to get their funds at no interest. It doesn't even make financial sense. And so one of the things about public banking is, yes, it can be used to create better infrastructure and fund projects on the ground in states and localities, but it's also just smart from the standpoint of economics. It's smart from the standpoint of finance, because if you can not have your deposits go into credit derivative toxic mortgage assets that then get sold into small towns in Norway or wherever. I mentioned Norway because basically what these banks did was they repackaged things and they sold them to the far corners of the world, which is part of the reason, and part of those farthest recipients were in Europe, which was part of the reason the European crisis has been ongoing and happened. So there are connections to really bad decisions along the way. These connections cannot be made to the bank in North Dakota, because the Bank of North Dakota didn't need to do this, because they preserved their capital in their state, because they preserved their revenues in their state, because they were still able to give out 38% of commercial loans to businesses in their states out of their loan portfolio, and almost 30% of their loan portfolio to students at far lower rates than any of the big six or other banks would even think about giving out student loans. So what they managed to do was maintain and repair an economy, or isolate their economy in ways that one could not have done if we had had all of our money at JP Morgan Chase or at any of the big six banks. So the idea of bringing it back, of bringing it home, of bringing it into a state, of bringing it into a local area where we can actually have control over it, is exactly what created the big six banks. However, they don't have the moral responsibility, the accountability, the regulatory infrastructure, the need to be careful with it and to be publicly oriented with it. And they're not going to, which is why, rather than waiting for that sort of stability to come from the top down, which, I mean, Mike mentioned as well, this is not going to happen. It's not going to be something that's endowed from the national political financial establishment on down. It's something that has to be captured and created and moved from the ground up. And that's what all these initiatives might turn out to be different. A Colorado bank might look different from a bank that started in the city of Santa Fe or Seattle or wherever else. And they're hard battles, because the large private banks have made a racket out of consolidating all this capital and consolidating all the power that that capital gives them. But it's still money that can be siphoned off. It's still money that can be used for productive uses. I asked August Miller, is he still here? No, the farmer who was here. I think we were all kind of moved by, he left, by a story. I asked him before, after dinner, about the numbers. Because a couple of people asked me after he spoke, okay, so how would a public bank help him? Because I think we all recognize, among other things, among reducing student loans, among having farmers who can afford to eat their food, just like as Ellen mentioned, Henry Ford used to pay their workers enough to buy his cars, which certainly helped Ford cars. And he gave me some numbers, and this is just one example of a way that a public bank can help him or farmers here in Colorado. And he said that an acre of land, I'll probably get some of this wrong, I know numbers, but I'm not real up on farming, I have to admit. But an acre of land costs like $140,000 if you buy it. But if it's purchased by some sort of a state or local council, then what could happen is these farmers could sort of rent or work that land. And what he said to me was that they could basically make $20,000 on that acre after cost. So rather than making $2,500 to $5,000 in salary on an annual basis, he can get paid like a normal person. Any of the farmers working an acre of land can get paid a reasonable median salary, but also after that, after cost, after everything, there's a $20,000 profit to be made off of that 1 acre of land. In return for which the community gets food or whatever it is that's being planted that is actually better, that's more organic, that has more local ties, that can be used in the community and so forth. So there is a way to actually use a public banking decision-making process to help what we eat, to help the farmers stay in the state, and also to have some money left over after all the expenses and after all these costs and after all the food is brought back, to make a profit on whatever loan would be made to make all of this happen. So those kinds of things add up. That's on 1 acre, and then you multiply by 2 acres and 10 acres and so forth, and all of a sudden you actually have people who have reasonable wages for jobs, you have land being worked, you have a public bank that's associated with good food being brought in and more people staying here who are working it, and you have money left over. And so that's the kind of thing that a JP Morgan Chase would never consider finding a way to provide financing for. So these things do go back to a local level, but they go back in a smart financial way as well as a moral way to that local level. And that's the other thing about this kind of autonomy that a public bank or a public-private partnership at a local level can bring, is that idea we bring back morality, we bring back jobs, we bring back financial authority into our hands, because while we're still fighting and should be fighting to split up these banks and to reduce their derivatives position and reduce the risk that they impose on the rest of the economy, where policy is actually helping to bulk all of that up, we can at least be simultaneously working to fortify what we have from the ground up. And I think that's one of the biggest reasons to support and learn more and find ways around the individual initiatives at the state and local level, is because we should be doing that. We should definitely be doing that. I have 10 minutes, I think, for questions.
Yeah, the Glass-Steagall Act separated insurance from stock markets from banking. How secure today are TIAA or these nationwide these insurance companies? Are they going to get sucked up along with the banks if we have another crash?
Well, one of the things that those of us who follow the mechanics of the crash, like the insurance company AIG, which was at the heart of one of many aspects of the bailout and subsidization of these very large and powerful already private banks, was that AIG was an insurance company. And one of the reasons it was given by Hank Paulson, who was a former CEO of Goldman Sachs and a former boss of a boss of mine when I was there, but basically what he said was that, if we don't save AIG, then what's really the problem is that all of AIG's insurance contracts with its little people around the country were all going to sort of be null and void. And so it was really important to find a way to bail out this company, because he used as a kind of reasoning the fact that, you know, smaller individual insurance policy holders would be affected, the same way that the private banks use as a reason the fact that they have individual depositors and they need to survive and not fail because they are holding individual deposits, because legislation allowed them to hold so many of our individual deposits. So a lot of the insurance companies, not just AIG, but are involved still now with credit derivatives, which are an aspect of the market that were really at the heart of the subprime crisis. And not to go into a whole finance thing at like 7 o'clock on a Saturday night in Denver, but really what, I mean, just because we've talked about it a lot today, and some people, a credit derivative, really what it is me saying that, you know, if you default on a loan, I got your back, I will pay for it. And if you default, I'll pay for it. And if you default, I pay for it. But I don't have enough of that money to pay for all of you if you all default at the same time. So that's a sort of pyramid problem of a credit derivative. And then you attach them to loans, and you attach them to other type, and they get sort of codependent on each other. So I'm not just spotting you, you're spotting him, and you're spotting her, and it just goes on the line. So like I'm one little guarantee here. I'm one insurance company insuring. That's how this credit default swap started to exist. They were a loophole. They were called an insurance contract, not a financial security, so they escaped a lot of financial regulation by definition and by lobbying. I'm basically writing insurance. I'm protecting all you guys, protecting all of each other down to the back row, which obviously makes no sense unless all of you are paying me back. But if any point along the line that breaks, which is what happened in the subprime mortgage crisis, and it will happen with any set of loans that have that relationship with each other, everything falls apart. So to the extent that the insurance companies, which were always a go-to place for the banks, because they had higher ratings and they were looking for yield, they were looking for higher return than just investing in government bonds and so forth, they were big participants in the credit derivatives market. They are still big participants in the credit derivatives market. I mean, some of the ones that are connected to pension funds and other things have stricter regulations as to what they can get involved in, but there's still definitely a risk out there. And it's a higher risk today than it was because the last risk was subsidized to such a massive extent. So we're just starting, you know, instead of starting with risk here, we're starting at risk here.
I was wondering if there's any one reason why you left the Wall Street industry.
Oh, that's a long. Yeah. Well, no, I mean, I left effectively because I saw a lot of what was going on. I started very young. I mean, I started out of school. I had a math degree. I got a job at Chase. It was fun to be in New York. And that sort of evolved into many years in the industry and being international at Bear Stearns and then being ultimately at Goldman. And when I got to Goldman, and I've said this before, but we're among friends here, I mean, I just could not take the mentality of Goldman, particularly at that point in time. This was before the Enron crisis or leading into the Enron fraud and the WorldCom fraud, and there was so much activity around, you know, not just selling product away as fast as it could be sold and structuring it as complex as it could be so that you could take as many fees out as you could. But it was also this idea that things were really falling apart. I mean, I was involved in credit derivatives from that point. I was running the credit derivatives analysis group at Goldman Sachs for a while. So I mean, I was very intimately involved in some of this stuff, and it wasn't good. And what we were doing wasn't very good, and dealing with Enron wasn't very good. And so all of that kind of culminated in years of my own sort of longer other story. I mean, I was like the only Goldman Sachs managing director who was at the Ralph Nader rally in Madison Square Garden in 2000. So I mean, there was other stuff, you know, going on over the years in my head before I finally was like, okay, enough is enough. So.
You raised actually one of the biggest issues out there when you talk about CDOs and CDSs. I've seen recently on Zero Hedge people talking, I believe Shadow Stats was saying there might be as much as $1,000 trillion of derivatives, which would be about
a lot.
20 times what the entire planet produces in a year.
Right.
Have you seen any statistics? How do you get those statistics?
Yeah.
And can you talk about what is likely to happen in the next 2 years if there is some major ripples financially? Are they going to all come crashing, or are they going to find a way to keep the game going?
Yeah, well, the official statistics on derivatives in the market, and that includes things related to credit, interest rates, which are interest rates being the really primary aspect of derivatives, is somewhere under a half a quadrillion. So it's somewhere officially, it's a huge number, around 500 trillion. The reason Zero Hedge and other places have, I mean, which is really kind of big already, right, is that it's that ripple effect. I mean, a lot of that stuff is unregulated. A lot of that stuff trades in contracts between individuals. It's like, I have a contract with you, you have a contract with him, and so forth. No one sees a lot of this places along the way where contracts can get multiple sort of users involved in them, because I contact you to him, you go over there, you go over. All of that can happen and create more and more of actual derivatives, what they call notional risk, or these points along the way that isn't even accounted for in the official records, which are kept by, well, a couple places. The Bank of International Settlements keeps the global report of derivatives on a quarterly basis, and the OCC, which is the Office of the Comptroller of the Currency here, keeps it for the U.S. banks here, which the U.S. banks control, as I mentioned before, the big six, about 45% of the global exposure. So when Zero Hedge talks about that, yeah, those could potentially be very real, but some of the numbers come from these organizations, and then you make the assumption that there's all these other connections that you can't capture at all because they're not being reported.
So what you're saying is that these are banks doing it, but when you have other financial institutions or the non-banking arms, that's completely under the radar.
Well, even some of the banks are reporting. The banks have to report to the BIS and the OCC their derivatives exposure, which doesn't necessarily have its own transparent set of reports. It's sort of like, this is what we said we have. So to the extent that those are even correct, other and those might be with other counterparties. They might not just be with banks. They could be with corporations. For example, someone talked before a little bit about oil and oil prices. When did I think them being lower, and how that impacts some of these credit derivatives and these relationships? Well, same thing with them subprime. If a bank has all of these side contracts related to the performance of a subprime loan, and the subprime loan goes south, all of these contracts are effective. It's the same thing with loans to, say, a corporation. If you make loans to, say, a mid-sized shell corporation or whatever, it's the same thing. If you do that multiple times and you offset it multiple times with multiple contracts, then you have all this extra risk in the system. And a lot of that isn't transparent. A lot of that is not reported.
Would I be correct in saying that the derivatives reporting is like first level reporting? In other words, they're immediate risk, but all the other levels or all the other tiers are not being reported.
A lot of them may not be reported, but also what the banks tend to do with how they also report risk, aside from reporting the actual size of derivative, they contend that all of these really big numbers are actually not risk. They contend that when I did this deal with you and you did it with him, you actually had the opposite deal with Michael, so you canceled out the risk that you have with Jim, right? So a lot of what the banks, what Jamie Dimon says, what banks say, how Goldman Sachs reports its numbers and so forth, is that a lot of this risk gets washed out. And so again, it's really hard to capture. So people like me and Zero Hedge and so forth say, that's great, as long as everything's fine, as long as there is no meltdown, as long as there's no subprime, to the nth degree crisis, you can kind of keep this shell game going. But at the end of the day, if a lot of things happen at the same time, which is what we saw in the subprime crisis, each bank is generally codependent to another bank, because somewhere along the line, there's a bank involved on at least one side of all of these contracts. And it could be the same bank, or it could be every bank involved in one transaction. And that's very hard to capture. And that sort of codependency, that's additional risk that they tend to say is not risk. And the Federal Reserve and other places require some capital. We talked about capital behind risk together. And obviously a small, pointing to someone who's not there, but a small bank doesn't have these derivatives exposure problems, yet they get hit with some capital against a similar type of problem. The bigger problems require much more capital than in reserve to fix if everything goes wrong at the same time than any bank has than than anyone has. And that's part of what happened last time. That's why the Federal Reserve has $4.5 trillion of debt on its book, doing nothing productive at all anywhere, just to basically give cash and keep cash flowing into the banking system so they can continue to, fund all these things that have no actual productive value.
So in this round robin of CDOs and CDSs, the fatal event would be what's called a counterparty failure.
Right. Well,
And what size of an event would it take to cause a fatal level of counterparty? Or would all these banks just kind of all walk away from them, tear them all up, and pretend like they never happened?
Well, no, they didn't. That's what they could have done instead of having AIG bailed out. One of the reasons AIG got bailed out, going back to a counterparty problem, is AIG had a relationship with Deutsche Bank and with Goldman Sachs and with Merrill Lynch. And they were looking at a situation where all this stuff was going wrong at the same time, and AIG was like, I have no money. And so what could have happened, rather than us bailing out those banks with actual cash, could have been for Goldman Sachs and AIG to work it out, going back to the beginning question here. But they didn't work it out. The government worked it out for them and basically lent money through AIG to Goldman Sachs, which should have been the responsibility of AIG, who had no money. So therefore, it should have been a loss to Goldman Sachs, because it would have been like, okay, well, you made a deal, you took the risk, you decided to do this transaction. You're big people, but that's not what happened. What happened was the federal government stepped in with all these extra reasonings of AIG potentially falling apart on insurance holders and regular people who didn't benefit from any of this, and that's what happened.
I'm interested in our own solutions and what I consider a kind of regional bank, which may be several counties. But what should we expect? What is most threatening to Wall Street about what we would do if we tried to establish a regional bank?
See, the Wall Street's main fear, and this is what's driven all of these mergers over the last 100 years and all of the politics and all the relationships that have enabled them to happen, the main fear is just losing control. And the main impetus for mergers and for deregulation, for repealing the Glass-Steagall Act in 1999 after a bunch of other related kind of swipes at this separation regulation and the idea of buying banks across states and all the other regulations that had been in place, was because they wanted to get bigger and more concentrated. So when you start to talk about the reason why they would be threatened, it's because even a tiny bit of chinking at that power, at that concentration of capital, annoys them. I mean, it's not even, it doesn't even necessarily, it's not really going to affect JP Morgan Chase in general unless everyone starts doing it. That's their fear, right? So the impetus of the big banks getting organized against having their deposits go and be retained away from them, so away from their control. It's about control and power. So the real issue is not to have it be a snowball effect. That's what they're scared of. They've spent a lot of time and a lot of work and a lot of lobbying and a lot of lawyering to get to where they are today, and it really works well for them. And that's really the major thing. It's not like the economy would fall apart. It's not like they're concerned about, if we help protect sort of public interest or public infrastructure, public projects, we're going to lose money. It's more about the idea that if you have that knock-on effect, you lose control, and that could lead potentially to a loss of money. So it's the first part is just trying to protect the sort of armor around what they have. Yeah.
Granted that you have relatively incomplete data or knowledge of the derivatives investment in petroleum companies and so forth, what's your analysis of what could happen with a prolonged lowered gas price or petroleum price?
All right, real quick. There was about $780 billion worth of loans that have been made from this cheap money that the Fed's gotten after the subprime crisis occurred, when the banks decided we need to do something else. We're not going to give subprime loans anymore. That's kind of over. We'll do something else. We'll give money to corporations on a sort of riskier corporations. And the oil and some of the shale companies kind of fit that bill. So out of $780 billion, or sort of up to $1 trillion, depending on the time frame of loans that were extended, about a quarter to a third of those are in the oil and gas industry. So if you equate that to the fact that the subprime loan market was about 5 times that, but the fallout related to the subprime market crash because of the assets that were created and the credit derivatives on top of it created a much bigger crisis, which is still being felt globally. $250 billion worth of oil and gas defaults could be a big problem. So to the extent that there is a lower prolonged oil price and companies have to start to close and default, because of these knock-on effects, because of these interrelationships, what happens is little defaults have a very big magnified repercussion. And that's kind of the worry. That's why Citigroup went to Congress and said, yeah, I know that the Dodd-Frank Act kind of really did have their back. That's a whole other discussion that we can't have tonight. But we want to just make real sure they have our back, just in case these loans start to go bad and the derivatives we have associated with them, they're called CLOs, they used to be CDOs, go bad. And so it can actually create a knock-on effect, with prolonged rates. And they're trying to avoid that and have that be subsidized. My mic just turned off. That's a sign. Subsidized by the government, which again is why we don't want to have subsidization at that level for those kinds of risky transactions and loans, as opposed to having that capital available for the things that we can see on the ground that actually help us and our communities and our states on a regular day-to-day tangible basis.